But first tonight, to the top story today, annual inflation has pushed up to 6.8% over the year to April, much higher than the 6.3% expected. This high inflation means it's almost a certainty we'll see more rate rises this year, perhaps as soon as next week. It's not good news for our economy or for families already struggling with the cost of living. And it raises the question, was the Albanese government overly ambitious about when inflation would return to target levels of 2 to 3%? The budget forecasts for inflation had it coming down to 3.25% in 2023 to 24 and then falling to the target level of 2.75% in 2024 to 25. These forecasts, published just a few weeks ago in the budget papers, are already looking shaky thanks to today's inflation data. At the time, global ratings agency Standard & Poor indicated that they felt the forecasts might not be accurate.
The wage outcomes, the RBA has been warning that we see wage outcomes spiral. And on a minor note here, we are seeing wage outcomes in the aged care sector. They will kick in next year at 15% pay rises. So while the government is talking about a minor cost of living package of $20 billion not adding to inflation, there are other things in the budget that could actually stoke a small proportion of the inflation market.
The Prime Minister, Treasurer and Finance Minister have all told us in recent months that inflation had peaked already and was now falling.
Signs that inflation has likely passed its peak and is beginning to moderate.
There is growing evidence that inflation is expected to have peaked in our economy and is now beginning to moderate.
Inflation peaked at the end of last year and it is moderating now.
But economists fear, they question whether inflation could be once again on a rising trajectory.
It's clear now that inflationary trends in Australia continue to be upwards and in fact not downwards as the Reserve Bank and the government would hope. So the number today came in at 6.8%. That's the annual rate. The market forecast had it at 6.4%, up from 6.3% the previous month.
After this inflation news hit today, the government held a press conference on The Voice. The Voice was also Labor's first question in parliamentary question time today and its second. And fair enough, The Voice legislation passed the lower house. But you'd have to wonder if this was the most pressing issue facing families right now. So let's look at what is causing inflation to remain sticky. Electricity and fuel are the biggest contributors, but also food and drinks and rents as well. Treasurer Jim Chalmers insists today in Parliament that the peak of inflation is behind us.
But it is well below the 8.4% peak it reached over the 12 months to December last year. But what we see in the data today is that the ABS is pointing out that the tick up in the indicator this month is being largely driven by the changes to the timing of the fuel excise. The peak in inflation is behind us.
And Peter Dutton then accused Labor of misleading Australians by promising that the cost of living would be cheaper under an Albanese government.
The Prime Minister clearly promised Australian families before the last election no family will be worse off, and that he had, and I quote, lasting plans for cheaper mortgages and better pay. With the typical Australian family now $25,000 worse off since Labor was elected, why won't the Prime Minister apologise for misleading Australians?
This morning's monthly CPI release from the Australian Bureau of Statistics showed inflation has once again risen, higher than even the market expected. Will the Prime Minister finally take responsibility for this cost of living crisis that is hurting so many Australians?
If inflation remains this high, the concern is that it could become entrenched. And some economists even worry that we might experience stagflation when inflation and stagnation happen at the same time. This is when there's a weak economy, high inflation and a sharp rise in unemployment. The World Bank even warned about this possibility just 10 months ago. But when National Senator Matt Canavan asked the Treasury Secretary at Estimates if he was worried about stagflation, he said it was only a small risk, but still a risk. Now, the shock inflation data today dropped just half an hour after the Reserve Bank Governor Philip Lowe finished a grilling at Senate Estimates. It's almost certain we will face more rate hikes, but Lowe was quick to point out that this was not because of the federal budget.
The budget didn't change our outlook for interest rates. We incorporated the broad parameters of the budget into our forecasts.
Is the most recent budget expansionary, contractionary, or is it neutral?
Well, it hasn't changed our outlook, but there was additional spending in the budget, and that's at the margin expansionary.
Economists like Chris Richardson have disagreed and have argued that the budget is inflationary. While Philip Lowe wasn't critical of the federal budget, he did seem to be at odds with the government when it comes to the impact of rising wages. Lowe says rising wages will become a problem if productivity doesn't lift.
The reasons for weak productivity growth are complex. I think partly it's due to the pandemic. Businesses were in survival mode rather than growth mode, and investment slowed down, and there were disruptions, and you couldn't get investment goods and you couldn't get people. So all those things hurt productivity growth during the pandemic. That's now behind us, so perhaps we'll now see productivity growth pick up. If we do, and we return to 1% productivity growth, which is what we've done historically, then the current level of wage growth is not problematic. But if we don't, then there is a reality we have to face into. If there's no productivity growth, then it's hard to have increase in real wages.